Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the markets. As always, please don't use these for trading purposes. They are for information only. Start here with the weekly chart of the S&P 500 going back to 2021 here on the left side. And you can see the bear market 22 is when the Fed was raising interest rates. And we've had a really nice run here. Start of 25, definitely forced start to it, but big rally after that. All-time highs right here, 7,000 on the S&P, 7,002. And then little reaction back recently. Broke the trend line that we had going and the support. So see how that plays out. For right now, it has broken its major trend line, but not by much. And you see it's bouncing back a little bit this week. So it could be just the market looking for an excuse, and it found it with the Iran war thing going on for people to reposition. But to date, we haven't really seen the market sell off all that much. If you're looking at the big picture there, let's go down in a little more detail. We'll go to the daily chart here. And this is going to give us, going back to October of 24 here on the left side. So we're getting a couple of years there of data, and you can see here from November 25 through this period, it's just sideways. That's all it is, back and forth. We've had some days or weeks where you say, oh wow, the market's really reacting, but in reality, it's not going anywhere. It's just going into a sideways mode. It is very expensive, and I'd be careful about adding to new positions, that kind of thing. But as of yet, it hasn't. Even though some of the price indications broken down, and you can see here, we actually tested earlier this week the 200-day moving average, which is generally a big thing for the market to go below that. So it tested it, held it. So far, that was just little bit of a sell-off. We'll see how that plays out. We look in a little more detail here at the 2-hour chart. You can see last time I had highlighted just sort of the big sideways movement that we've gotten here for months, just back and forth in the range. Nothing happens. These gaps like here where you see them lower and everybody goes, oh my gosh, the Dow was down or S&P was down so much this week. It keeps coming back into the range. And we did break out of that range lower this week, as you can see, but came back into it, and we're kind of holding the lower end of it. So we'll see. Some of the things that aren't so promising are this line here is the bullish percent, the percent of the S&P 500 that's in an uptrend. And as you can see right now, it's down at 45. So over the last few months, even as we were up here at all-time highs, it's 67 and then 62, and that now lowering off. And generally in big bull markets, you'd want to see that in the 80s, 90s. You'd want to see all stocks kind of rising with the tide, and we're not seeing that. Not even half of the S&P 500 stocks are in an uptrend. Below that, you can see the advanced decline line here on the New York Stock Exchange. And that had been running up for months, indicating kind of we're getting more advancers than decliners days in the market. And just here in the last couple of weeks, that's broken down. That's coming down. So shows that maybe there is distribution, people pulling out of the market. We'll see if that's not just a function of what happened with the war, but right now the market's telling you, okay, there's some changes going on, and maybe we just broke a level to go to a lower number. Now, finally, the bottom one here is the VIX, the volatility index, and that's what people pay for insurance on their portfolios in the options market. And it is elevated at 25. We'd hit 30 earlier in this week, but that's not a real panic sell-off. Usually when you see a sell-off end and it's over with, you're going to want to see something 40 or 50. I mean, real panic. That's when buyers step in and say, okay, that's the end of that. We haven't quite seen that yet, so not sure if it's just getting started or that was just a mild thing to do with this bombing, but remains to be seen. Certainly be cautious. We can look here at some of the other inside the market things. The ratio of consumer discretionary stocks to consumer staple stocks, that had been coming down, and as I was pointing out for months, saying that, okay, maybe the market is getting a little defensive, people reallocating into different sectors. Did come off a lot. It's bottoming here in the last couple of weeks. That's a good thing. This is the same indicator. Technology versus utility stocks, the same thing. It had been really selling off over the last month or two, and now is maybe bottoming in this week. Biotech over the healthcare sector, that really didn't come off. So biotech's still doing well. Hotels versus utilities, that had been holding up, and now isn't. We're seeing utilities do a little better. So there's definitely some things under the market here that I'm not liking, but the price action hasn't said, run for the exits yet. It's just very much waving a caution flag. If we look at the interest rate on the 10-year U.S. Treasury bond, that's going sideways here. It's at about 4.2% and has stayed in that same range for years. We're just not seeing any great adjustment in interest rates, and that does keep the market stable there. We want to look at economics here, the GDP growth rate. The previous marker had been 4.4. Last one was 1.4. That's not so great. Non-farm payrolls last print was negative. We're seeing job loss there. And the one before it wasn't very strong. So some of the economic numbers are kind of looking a little iffy there. If we come down to retail sales, same thing. That's gone here to negative, and the one prior was zero. So maybe seeing a little bit of a slowdown out there in the economic data, in some of the things that I'm seeing inside the market, that the types of stocks that are advancing, and the price action. Definitely, good time to play caution. And I have been for a couple of months now, just moving either to just income paying dividend type stocks, or things that are hedged. There are a number of products out there that now that are will give you exposure to the stock market, but have a downside hedge to them using options. So it's great. A lot of new fun things. We go here to the valuation of the market. I've shown this in prior videos that the fair value, 20 times earnings on the S&P 500 here is about 46.81. We're up around 7,000, so it's way above it. This market is definitely expensive. That's not a good market timer, but it does show that the market is expensive, and eventually someday, yes, it will come back and revisit that line. It always does over certain periods. You just can't say that, hey, that's going to happen tomorrow and revisit. You just need to know that the U.S. stock market is very expensive and has been not making any progress here. If we go to back to that daily chart, we haven't made any progress here in 6 months, and meanwhile the internals, some of the things underneath the market, are showing us that, hey, there's a rotation towards kind of safety, and maybe we just broke a little bit lower. The only thing is, again, it's still holding that range. You'd have to get below this 6,500 number, which is also below that 200-day moving average, to really get things going and have people say, okay, time for me to start to head for the exits. And that kind of has a little bit of a snowball effect. And then finally, a chart I thought I'd show for fun. Just it's a little scary. This is a yearly chart of the S&P 500, going back to, let's see, we got 1926 here on the left-hand side. It's just funny. In 1926, it was at 10. And you just see this going sideways here. This is the 60s, and then the 70s, 80s, and how it's taken off from, in 1990, right around when I was getting out of college. Looks like the S&P 500 was at about 500, and today it's we've hit 7,000 in the last week. So it's just you see these charts and you say, okay, that just is a little scary, or looks like a market that needs to correct. And I'm not saying that it will, but because inflation has been driving everything up. Back there, you used to be able to get a nice steak for $15 or something like that. You can't do that today. So and inflation does hit the stock market as well. So just thought that was an interesting chart to show. So in the meantime, just I would be very cautious here. If we go back to the big picture, that we've had a really nice run here over the last few years, a couple of dips, and maybe we are due for another dip soon. It's certainly a very expensive market that might be just looking for a reason to get some profit taking, but haven't really seen the huge price action yet to make that happen. But to my mind, getting below maybe 6,500 there, because that would be something to get people sitting up and paying attention, and we might have a deeper sell-off. So hopefully this is informative and helpful. And thanks so much for watching. I'm going to put up our contact information here if you'd like to hear more about what we're doing with our portfolios, or anything like that. Please don't hesitate to reach out. And otherwise, hope it was helpful, and we'll see you at the next update. Thanks so much for watching.